For decades, there's been a sacred rule in personal finance. Just get to your first $100,000. Once you hit that magic number, everything is supposed to change. Your investments start working harder, your money compounds faster, and wealth finally starts building on its own. But here's the strange part. Millions of people are reaching that number today, and for many of them, nothing really changes. They still feel stuck. They still feel behind. Financial freedom still seems just as far away. What happened? Did the rule stop working, or was it misunderstood from the very beginning? The truth is, the story of the $100,000 rule is far more complicated than most people realize. It was never really about the number itself. It was about how money truly grows, how financial systems reward momentum, and why most people unknowingly hit the brakes at the exact moment their wealth is supposed to accelerate. The idea of the $100,000 milestone didn't come from some modern influencer on social media. It actually traces back to one of the most respected investors in history, Charlie Munger, the longtime partner of Warren Buffett. Munger famously said that the hardest part of building wealth isn't your first million or your first 10 million. It's getting to your first $100,000. His reasoning was simple. Before that point, nearly every single dollar of growth comes from your own effort, your job, your discipline, and your ability to save. But once you cross that threshold, something important starts to shift. Your capital, your money, begins doing some of the work for you. Compounding finally starts to kick in. Money you invested starts generating returns, and those returns start generating their own returns. In theory, that's the moment wealth begins to speed up. The logic behind this rule comes from one of the most powerful forces in finance: compound growth. Compounding simply means that your money earns returns, and then you reinvest those returns so they can generate their own returns. At first, the effect is tiny. If you invest $10,000 and earn an average of 8% a year, that first year only brings in about $800. That doesn't feel like life-changing progress, but as your base grows, the numbers begin to change. At $50,000 invested, that same 8% return produces about $4,000 a year. At $100,000, it produces $8,000 annually without you doing any additional work. As time goes on, the compounding effect accelerates. The growth curve that once looked almost flat slowly starts to bend upwards. This is why the first stage of building wealth always feels so slow and frustrating. Almost all your progress comes from saving, not from investing. The financial engine hasn't fully started yet. And for a long time, the $100,000 rule actually worked the way people expected. Back in the 1980s and 1990s, the financial world looked very different. Interest rates were higher, so even savings accounts produced meaningful returns. Stock market valuations were much lower than they are today. Economic growth was strong, and getting good investment returns was a bit easier. In that environment, reaching $100,000 really could create momentum. Your capital could generate consistent returns of 7 to 10% a year. At that rate, the compounding process started to feel powerful relatively quickly. People who crossed that threshold often saw their wealth start growing faster and faster each year. But starting in the early 2000s, something fundamental began to shift. Central banks around the world started lowering interest rates to try and stimulate economic growth. Then, the 2008 global financial crisis changed everything. To prevent a total collapse of the financial system, central banks rolled out massive emergency policies. Interest rates were pushed down close to zero. Trillions of dollars were created out of thin air through quantitative easing. Financial markets were stabilized with unprecedented monetary intervention. These policies helped us avoid a much deeper economic disaster, but they also quietly changed the entire environment in which wealth compounds. The biggest hidden change came from inflation, especially asset inflation. Over the past 2 decades, the cost of living has steadily increased. Housing prices have exploded in many parts of the world. Education costs rose dramatically. Healthcare expenses surged. Meanwhile, for many people, wage growth remained relatively slow. The result is that just reaching $100,000 in savings has become significantly harder for the average person. But the real twist comes after they reach it. Because while living costs went up, financial assets like stocks and real estate also rose dramatically in price. This meant many people found themselves spending more of their income just to keep up with daily expenses, leaving less money available to invest. This is where the $100,000 rule begins to break down for so many people today. When they finally reach that milestone, they feel like they've accomplished something major. And in many ways they have. But psychologically, something often changes. Instead of continuing to invest aggressively, many people slow down. They reduce their contributions to their investment accounts. They become more cautious. They assume that the compounding process will now take over and do most of the work for them. But mathematically, this is the exact moment when continuing to invest matters the most. Because $100,000 alone does not create financial escape velocity. It only begins the compounding process. Think of it like starting an engine. When you turn the key and the engine roars to life, the car hasn't actually gone anywhere yet. It still needs you to press the accelerator to build speed. The same principle applies to wealth. At $100,000 invested, an 8% return generates about $8,000 a year. It's helpful, but it's rarely enough to dramatically change someone's financial life. But as your investments continue growing, the numbers begin to shift in a much bigger way. At $500,000 invested, the same 8% return generates about $40,000 a year. At $1 million, it produces around $80,000 annually. At that stage, the compounding engine finally starts behaving the way people imagined when they first heard about the $100,000 rule. Over the years, many financial experts have tried to simplify the path to wealth with quick solutions. They tell you to start investing earlier, pick better stocks, or create more income streams. And while those ideas can certainly help, they often miss the deeper issue. This pattern doesn't just apply to individuals. We see it across entire economies as well. When countries have a small amount of debt, borrowing can accelerate economic growth. But once that debt becomes extremely large, governments often delay making difficult decisions and just rely on existing momentum to keep the system moving. Eventually, that strategy stops working. Compounding works both ways. Just as investment growth requires you to keep contributing, debt growth eventually requires more and more borrowing to sustain itself. The same mathematical forces govern both our personal finances and global economic systems. So, understanding the real meaning of the $100,000 rule changes how you should think about wealth. That milestone was never meant to be a finish line representing financial security. Instead, it marks the moment when your compounding engine finally starts turning over. But like any engine, it still needs fuel to keep accelerating. The first lesson is that the first $100,000 is difficult because you are the primary driver of progress. Your work, your discipline, and your savings create nearly all the momentum. The second lesson is that reaching $100,000 doesn't mean compounding suddenly replaces your income. It just means compounding has finally started to help. And the third most important lesson is that the largest wealth gains happen after you build sustained momentum. The difference between stopping at $100,000 and pushing on toward $300,000, $50K, or $1 million can determine whether compounding truly transforms your financial life. The great paradox is that the moment when wealth starts to feel meaningful is often the exact moment when people slow down. They relax, believing the hardest part is over. But in reality, that moment might be the most critical stage of the entire journey. Because in finance, just like in physics, momentum is everything. Once you start building it, protecting and accelerating that momentum becomes far more important than just reaching a single milestone. And that leads to a final, uncomfortable thought. Many of the financial rules we all follow are simplified versions of much deeper truths. The $100,000 rule was never meant to be a finish line. It was meant to be a signal that the real compounding process was just beginning. Understanding that difference can completely change how you approach money, investing, and long-term wealth. Because once you see how financial momentum actually works, you realize something important. The rules most people follow about money aren't wrong, but they're often incomplete. And the difference between understanding the full system and only part of it can determine whether your wealth quietly compounds or quietly stalls. Thanks for watching.